Welcome to Stocks in Translation, our essential conversation cutting through the noisy numbers, the mayhem, and the hyperbole to make it easier for you to find the right investments for your portfolio. I'm Jared Blikre, and my sidekick here is Sydnee Freed, as always, and we also have Caleb Silver back. He is the editor-in-chief of Investopedia, and I can't mince words about this. It's a big down day in the market. It's getting a little bit better. We're taping this on Monday, but we want to talk about risk management today, so that is our theme. Great theme for the day. Our phrase of the day is also risk management, and this episode brought to you by the number 5. That's how many rate cuts the market is pricing in by December. Why more rate cuts? Isn't necessarily something to celebrate. So Caleb, before we launch into our discussion about risk management, just want to get your overview of what you're seeing in the markets right now.
Yeah, it's a meltdown, and a lot of people thought this was coming. We maybe have been overbought, and now we're swinging to the oversold side. We do have those concerns about the economy slowing. You got mixed signals, right? You got good headline numbers when you look at GDP. You got good headline numbers when you look at consumer spending, which is holding up kind of barely, even though consumers feel a little tapped out. But inside the economy, the real feel is not very good. And then we, of course, had that jobs report that was slower, lighter than expected last week, and a rise in the unemployment rate. All of a sudden, the drumbeat around a recession, a slowdown is here, and nobody wants to own risk assets, at least these days. We'll see how long this holds on.
So let's get to our risk management definition here, our phrase of the day. A very meaty topic, so let's just dive in. Risk management involves identifying, assessing, and prioritizing risks as part of a strategy to mitigate the impact of adverse events. Crucial for protecting financial resources and ensuring long-term stability and growth. And so there's a lot to unpack there, and it means a lot of things. What does it mean to you, risk management?
Yeah, protect your downside. I mean, basically, but risk writ large, that 4-letter word is so important in our lives, but especially in our financial lives, right? We don't get taught risk in high school. We don't get taught risk in college. It's something we have to learn. When you get into the capital markets and you start to invest and allocate your money, you have to be thinking about your downside. And that really causes a fundamental question to be asked of yourself. How much of a loss are you willing to take? What is your tap out number? Is it 10%, 20%, 30%? And then building your portfolio around that. I am risk averse. I had a lot of financial trauma growing up, and I hate to lose 5 times more than I like to win. So I like to protect myself with a lot of risk balance assets in my portfolio. And for investors, you have to determine that number yourself. What's your sleepless number? What's your tap out number? That's risk management in a nutshell.
So if you're a passive investor and you just have, you might own a bunch of ETFs, you don't own single stocks, should you do anything when there's a sell-off? Should you check your portfolio? Should you sell anything?
You avoid the news, as they say.
Yeah.
Everybody always says, don't look at your 401k. I don't believe that at all. Look at your 401k. It is your money. Know what is in there. So if you're a passive investor, let's say you're a 401k investor and you've allocated towards some S&P 500 funds, some large cap stock funds, maybe some bond funds to balance out your risk a little bit. You should make sure that is in balance. We've had record highs after record highs coming up until the last few weeks. And guess what? Your portfolio is probably a little heavy on the technology side, right? On the S&P 500 NASDAQ side. Well, you're seeing that come down in this big sell-off. So you might want to think about loading into some value stocks that haven't been appreciated so much, or getting a little bit lighter and loading into cash right now, which is still yielding 5%. You can do that, but you can also buy a target date fund, which is what a lot of passive investors do. And those balance your risk as you get older, nearing that retirement date. That's been a popular choice for a number of years. I don't see that going away anytime soon.
On the other hand, though, is it time to buy a dip? If everything's going down and we know that tech has done very well, should you use this as a buying opportunity?
Yeah, for people that have a long-term time horizon and cash on the side, absolutely. Stocks are on sale. The thing about the stock market, and you guys know this well, is it's the only store in town where people run out the door when things go on sale because they're afraid. And I totally get that. But I've been through a few bear markets, and none of them feel very good at all. And corrections don't feel very good either, but I do know that we're always due for at least one correction, a 10% drop or more once a year. I know we're in for a bear market every 3 to 4 years. We haven't had one since 2022. So I know that these things happen, and I know that the first 2 times it happened, I was too scared to do anything. The third time it happened, I backed up the truck. And that turned out to be a great thing for me to do, to buy the dips, but also load in when interest rates were low, stocks were on sale, and that was a good move. But for people who have long-term time horizons, keep buying, and especially when things get lower, definitely keep buying, because then you're lowering your average price, your dollar cost averaging in, and we love when people do that. It's a great Investopedia term, dollar cost average.
You can do this a number of ways, and this is something that Warren Buffett talks about, how to get into the market. You might just automatically have every 2 weeks from your paycheck a certain amount withdrawn, and so that's just going to get you into the market, into your positions, probably a passive investment. Every couple of weeks, you're just going to be adding a bit to it, and your dollar cost averaging, if you're adding as the market's going higher, your dollar cost average is going higher, but you theoretically have those returns to sit on as well. And if the market goes down, well, you can lower your cost basis such that when the market goes up, then you have that. We've been talking about more passive investors and what to do and how to approach these things. What about active traders? Because I know I come from an active trading background. I'm thinking about risk management before I enter the trade. I need to know where I want to get out before I get in.
Yeah, so more advanced investors and traders do this on the regular. They set a threshold before they go into any trade of how much of a loss they're willing to take, and they put a stop order on that number. So if the stock breaches that point, they're out automatically. Also, most advanced traders, never risk more than 2 or 3% on one individual trade. You talked about diversification. That's how they do it. And P.S., they do most of their trading within a 2 to 3 hour window, probably early in the morning, make their trades. They don't walk away with any money on the table, right? They don't get emotional about it. It is an equation, a math equation they're solving. So they're protecting themselves on the downside. They're mitigating their risk by not going in too hard on any one trade. They know their downside, and they also know at what level they're willing to take a profit, their limit price, for lack of a better word. They're setting that limit as well. So they have their range, and they're trading within the range. They are really good at risk management because you can't be a successful trader and make it to tomorrow unless you have risk management skills.
Yes.
One thing that I helped produce this morning was we checked in on the VIX, the fear gauge. Is this a good time to buy it? Because when I saw it, it was like really high compared to what I'm used to seeing.
Yeah, the VIX or Volatility Index, the fear index, a lot of people call it, really tracks that fear in the market, looking at put options out for the next 30 days or so. If people are betting against the market aggressively, buying put options against the stock market, you're going to see that VIX rise. Well, that VIX is screaming like a toddler that just dropped its ice cream cone in the park. It is on fire right now, and it's been asleep for like 2 years.
Yes.
So it's up right now. Is it a good time to buy it? No. The VIX is very volatile. You talk about catching falling knives. The VIX is one of them. And also, it's worth noting that the VIX was that measure of fear in the market for a very long time. But then we got 0 days to even options, and there's a lot of traders betting just on a little 8-hour period of stock market activity, and the VIX is kind of that 30-day look. So it's a bigger macro look, but it doesn't capture the intense volatility we're seeing moment to moment during sell-offs like these.
Yeah, I think that's a great question too, because a lot of people think, we're in the midst of this meltdown. This would be a great time to buy protection. But in fact, the best time to buy protection is when you don't need it. And that would be several days ago. So it's a little bit late for that. But this conversation is about helping people prepare for the future. So how does this enter your thinking about risk management?
Yeah, well, you mentioned that the best time to buy an umbrella is 3 or 4 days before the rainstorm. You go out when it's raining and they're about $10, $15 a piece. So yeah, it's a good time to always buy protection and make sure you always have that understanding inside your portfolio. A lot of people don't even know what they have. So first of all, know what you own.
Sure.
Number 2, make sure that you have protection. You are so-called hedged so that you're just not all loaded into 5 or 6 stocks. There was so much concentration in the stock market this year with NVIDIA and the mega cap techs and the semiconductor stocks. It was bound to spill over, and that's kind of what we're seeing here. Those stocks are getting sold off the most. But if you don't have protection, whether it's in the form of bonds or some cash to mitigate your losses here, you can still get 5%, as I said, in CDs or high yield savings account. You're going to feel this loss much more amplified than other people. So make sure you have that protection in your market. We have rules in our portfolio, in my family, where when markets hit a certain gauge, hit a certain level, we automatically shift and rebalance into other areas of the market. Now, I work with a professional. Mm-hmm. He does this for me based on our agreement of how much risk I'm willing to take and how much of a loss I'm willing to take. For people that don't have that and are doing it themselves, make sure your portfolio is balanced and that it's not all loaded into one sector of the market.
I think that's really interesting about your family and the finances. Do you abide by a certain ratio, X% stocks, X% bonds, X% commodities, something like that?
Yeah, we have a rules-based approach, which means when the market is trending a certain way and we look at certain technical indicators like relative strength and moving averages, but also the direction of certain sectors, we pile a little bit heavier into those sectors. But we also have always, in effect, what we call our backup or our goaltender option, which makes sure that when things start to sell off, off, we are not completely exposed to that, and we'll shift assets from one part of the portfolio to the other based upon market conditions. But we do that with evidence. We don't do that on a whim. We don't do that out of fear. We don't do that because the financial TV headlines are screaming markets in meltdown. We do it because we have rules that we follow. And so far, so good on that.
You know, sitting in your spot at Investopedia, you have a bird's eye view of a lot of things going on in the market just by virtue of the things that people are typing into your search bar. What are you seeing people flock to your site for today and in the days past?
Did you see my correction search?
Correction was there. Bear market was definitely
Yes.
there. How long do bear markets last? People are wondering, first of all, we're not in one, at least not yet.
We're down 7%, so let's set the record straight.
Right, but people are hearing this, so they're looking for that. They're also looking for ways to protect themselves, but there's also some people, promiscuous investors, that have seen this before. They're looking for leveraged ways to get into certain sectors or certain stocks, whether that's a triple leverage ETF that favors tech stocks because they've been beaten down so bad, or it's other ways to approach the market right now, given the fact that there's so much selling. There's that old expression, be greedy when others are fearful, be fearful when others are greedy. I think Warren Buffett has said it. Many investors have said it. Funny thing is, Mr. Buffett's been selling over the past couple of months while the rest of us were buying and sending the S&P 500 to record highs. He was out there selling some of his biggest stocks.
Yeah, he was getting rid of Apple in a big way. We can talk about that after the jump here, but we do need to take a short break. Coming up, we're going to be talking the number 5, and we have a fashion showdown for the VIX Volatility Index. You heard that right. We take the VIX out in style. All right, we are back, and this episode brought to you by the number 5. That's how many rate cuts investors are now pricing in by the December meeting. That number was only 1. It was about 1 at the end of April, and it was 6 at the beginning of the year. So we've kind of come round trip here. But things feel a little bit different, don't they, than they felt at the beginning of the year. Feels like we might really need these rate cuts right now. I mean, it just feels like today is a little bit more dire than it was on December 29th, 2023. Do you see the difference?
Absolutely, and you're already hearing the drumbeat getting louder about a potential emergency cut, and the Fed's going to meet.
Oh, what does that look like?
I didn't even know the Fed could do that, by the way.
Absolutely. The Federal Reserve has broad powers when it comes to monetary policy and interest rates. And we remember from the COVID, when the COVID pandemic hit and everything was shut down, they didn't really wait for a Fed meeting to make those moves, and they didn't wait during the financial crisis. So the Fed has broad powers to do what it feels is necessary to make sure that we're in line here. And it wouldn't surprise me, but it wouldn't look great given the fact that Fed Chair Powell was so confident and the Federal Reserve was so confident that the economy was looking so good. And as I mentioned, headline numbers look pretty good. Inside the numbers, things don't look that great. So if the Fed does an emergency cut or cuts before September or cuts more in September than anticipated, it's not a great look because they're kind of going back on what they said. But the Fed is data dependent. And to be fair, when the Fed held interest rates last week, they hadn't seen the July jobs report, or said they hadn't seen it, and they're not political, so they don't worry about the election. And they say they don't worry too much about the stock market. But when you get a pretty good rout, sometimes the Fed does step in and just calm the waters a little.
So this is my first interest rate cycle, watching the Fed hike all the way up, and the first one where we're seeing hopefully that they make a cut soon. So I don't get it. Did the Fed just get this wrong? Did they just make the wrong call, not cut fast enough? For so long, investors have been crying for a rate cut. It felt like it was coming. It felt like it was coming. Then it was not. Then it was not. I guess I just don't get, as someone walking around on the street, why they didn't just do one little preemptive cut, maybe 25 basis points.
Yeah, well, the Fed has been pretty premeditated and very transparent about what it's doing. We've been covering markets a long time. There has been no Federal Reserve like this that pretty much tells you what they're going to do.
Yeah, I mean, remember Greenspan, he didn't even publish a notice. There was no announcement at 2 p.m. the way we're used to on Fed Day. There was nothing. You had to go to the money supply numbers the following week to back into what the Fed had done. So things have changed quite a bit. You brought up something really interesting, and I want to get back to, I don't know if you finished your answer there to Sydnee.
Well, I just said, did they get it wrong?
Yeah, well, the Fed has two jobs, right? To keep inflation in that 2.5% band, right? Keep inflation sort of growing, but just a little bit, but also to keep the labor market at full employment. That's between 3.5% and 4%. The fact that we're at 4.3%, you could say, yeah, they missed what was happening in the jobs market. But to be fair to the Fed, job gains have been pretty robust.
Oh, they're still positive,
Right,
too.
and they're
above
still
100,000.
positive, and there's still a lot of jobs out there, and wages are still rising. And that's one thing the Fed was trying to cool, right? We like wage inflation. That's good for workers, but too much wage inflation makes businesses ratchet up their prices, which just produces the inflationary cycle over again. So think of this as a hot air balloon, the Fed trying to keep it not too high, not too low, or Goldilocks for that matter. And did they get it wrong? In retrospect, it looks like they might have, but they were dealing with the data they had at the time.
Let's consider, I want to back up to a statement you made a minute ago, and that is the Fed could conduct an emergency meeting, could lower rates, and you said, and I believe you're correct, that the optics on that would be bad. And that's because we've seen this before. When the Fed has to make an emergency cut, it's admitting that we're in recession and things are getting bad. That's when I would expect the market to start heading into bear market if it's not already in that point. But this also ties into something that you wanted to talk about in your notes, which I like, which is that Fed rate cuts are not always good for the market.
Yeah. Fed rate cuts get investors excited because money becomes cheaper and companies borrow more, they expand, they hire, they acquire other companies. That can be a good thing. And smaller companies love low interest rates because they borrow so much money. They're so heavily in debt. When rates come down, their balance sheets look a little bit better. I get that. But when the Fed cuts into an economy that is slowing, traditionally you do not see higher returns most of the time after that. Most of the time you see pretty mixed returns, and the tendency is for the markets to go lower because, as Jared pointed out, it's an admittance that the economy has slowed potentially into a recession and it needs a jump start. It needs a jolt of energy, so lower rates will do that. Lower rates also make money cheaper for some, but it makes us spend more, which produces another inflationary cycle. So the Fed's got to be careful with that. Also, when the stock market is at record highs, as it was a month ago, why cut rates when companies are still producing profits, even though interest rates are pretty high? Profits that are almost record high profits when you look at it quarter over quarter. So there was no reason to from that perspective. But if you start to hear this drumbeat get louder and louder, not just from companies like a McDonald's or a Starbucks that says consumers are holding back on purchases, and Target and the others, but when you start to see big purchases being held back by companies, industrial companies that have these long cycle orders,
good point.
Then you know we're heading into trouble right now.
We have Jackson Hole later this month for the economic symposium. Do you think Powell is going to say what he's going to do at the September meeting, kind of to move that along? Or do you think
a month early, just tell us.
Just tell us, or could that be the emergency cut?
Up in the
at
Grand
Jackson Hole,
Tetons.
well, everybody's going to be there. I've never heard of that, but I guess it is possible. I mean, if they're all in the room and
It's basically a Fed meeting.
If something happened that was extreme, maybe, but I would say that's a long shot.
Right, it's a Fed meeting with fly fishing. So to break from fly
100%.
fishing, it depends how the trout are biting. I don't think that they would do that. I think there would be a lot more transparent, like they have been all along, and they would let us know that there is going to be a Fed announcement, and we would all plan for that. That's the way this Federal Reserve operates. No surprises, no drama. But we're getting plenty of drama in the markets right now, which we'll see if the Fed reacts to that, because Fed Chair Powell has said over and over again, we don't react to political influences and we don't react to markets influences, but sometimes the market influences start to bleed into the economy, and that's where the Fed has to get active.
All right. We want to circle back to the VIX right now. It has been on fire today, spiked up to 65 on Monday. That was the highest since March of 2020, the depths of the pandemic. Now, on the day it first hit that level, that's in the 60s, in March 12th, 2020, the S&P 500 would close down 26% from its recent all-time high that day. So S&P 500 down 26% when the VIX hit that level. Today, roughly the same level on the VIX. The S&P is only down 8%. So back in 2020, that day would not be the low. That 26% loss would eventually worsen to 34%. And where I'm coming from here, where I want to get to, is which market epoch is wearing this VIX surge better, today or March 2020? So looking ahead, are we going to look in the rearview mirror? Is this a one-off, or is this more the descent into something more serious?
Great question. I think that the fact that the VIX is this high right now compared to those periods, just think about what you just said, is a little bit outrageous. What precipitated all this? A kind of a sluggish July jobs report, Japanese central bank hiking rates by a quarter point. Is that is that really on par with what we saw during the pandemic? Is that really on par with the great financial crisis? Is that really on par with any of these big sell-offs in terms of what was happening in the market and economic dynamics around the world? I don't think so. This is an overreaction, I think, to people thinking the market was way overbought. And don't forget, a lot of people have made a lot of profit in these stocks, especially the Mag 7 and some of these other mega cap techs. So taking profit right now, this point in the year, not crazy. That's what Buffett is allegedly doing when he's selling his big stake in Apple and Bank of America. He's carrying massive capital gains, Berkshire Hathaway is, and wants to avoid a monster tax bill come next year when we don't really know the future of taxes.
Yeah, I got to say, I'm really on board. I'm more inclined to think this is a one-off. And yes, things could be getting a little bit worse over the coming days, but I don't see it as something that develops into a crisis, the magnitude we haven't seen. You know, pandemic was its own animal. We can go back to the global financial crisis. We had a lot of leverage built up in the system that had to be let out. I don't see that in the U.S. What I see here is Japan. Japan has a leverage problem. They're deflating today and it's bleeding over into the rest of the world. But unless that is systemic and that is ongoing over there, I don't see how it affects the rest of the world, you know, on an ongoing basis over here. So we have a few minutes left.
Yeah, we're going to get personal, Caleb. You ready?
Here we go.
So we have Investopedia turning 25.
Yes.
Yes. Tell us a little bit about the
1999.
journey. Yeah.
You date back to the last century, along with Yahoo Finance, by the way.
I know.
1996.
We are cousins of Internet 1.0, and I'm so glad you guys are still here because I use you all the time, and I thank you for letting me know.
Oh, yeah. I use Investopedia all the time.
Well, we've both been around a very long time trying to educate investors about how to do this right? So we were born in 1999 in Edmonton, Alberta, in Canada. A couple of really smart guys had this great idea to put the dictionary for financial terms on the internet. They also put test prep for people who were trying to get into trading, whether it was Series 6, 73, people trying to get into the capital markets. And this was very early, right? 1999. They had this idea that if maybe they put that dictionary online, maybe this company in California called Google that was being founded in this garage in Mountain View might want to index it and point people to that. Well, they were absolutely right about that. And they grew Investopedia from this little idea into this great big site that was bought and sold several times throughout the years. We're now a part of the Dotdash Meredith family of websites. We're one of 40 odd websites there, but we are the big finance brand there. And we've just managed to continue to evolve, and we do that just by keeping it super simple, answering people's questions about money. If you do that and you do it well, you do it with integrity, with experts, you can survive on the internet for 25 years, as it turns out, and it's a terrific brand. I'm really proud to be the editor-in-chief of it, and wherever I go, people like you thank me like I did it. I didn't do it. I'm just part of the team, so I'm really grateful that we're able to help people out, and I think we have another good 25 in us.
And you predate Wikipedia, which I was surprised to learn a few minutes ago that it was founded, or I guess launched in 2001, so by a couple of years there. Want to ask you about financial literacy. I know this is a topic near and dear to your heart. We got a couple minutes here, so tell us what you've been doing in that field.
Yeah, well, our mission is to educate people about money writ large. But in the last few years, we've been realizing that we haven't been talking to everybody. Neither has the financial services industry or financial media. We just don't talk to all the communities that need it, especially the underserved communities, and especially really young people. We know young people come to our site because they might find us through their search engine, but we wanted to put our content and our curriculum to educate young people about money front and center into high schools. So we've been on a mission the last couple of years, going into public high schools around the country, giving free curriculum to the teachers so they can teach investing and wealth building as part of their personal finance curriculum, but also training teachers how to teach it as well, and working with nonprofit groups that are really doing this on a large scale to give them our material for free so they can take it out to schools as well. We got to get people in underserved communities. We got to make sure they're getting the same access to investing and finance education as everybody else. So we are actually on the ground doing it, and we're going to continue to do that. And we've had some great partnerships over the years, and we'll continue to do that going forward.
Yeah, including Yahoo Finance here. So we wish you well on that journey. And guess what? Time flies. We got to wrap things up here, but it's been great having you, Caleb. Hopefully by the time everybody's viewing this at home, this is just a distant memory. But if it's not, re-review the sections on risk management. That will serve you well. Signing off here, Jared Blikre for Yahoo Finance.